Hello folks, Steve Lentz here with Discover Options here at OptionVue. Welcome to this presentation of the Inside Wire. It is October 17th, 2017. Presented materials for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So today, folks, we are coming in for a landing. We have two more sessions today and next time to go over the back testing of our best practices broken wing butterfly. And I'm going to show you where we've been a little bit, where we're coming in for a landing, and I think you'll be very pleasantly surprised at the 100% wins that we've come in for a landing on over the last 2 years on this approach. Pretty darn good. So let's take a peek at what we've come in a landing on in terms of implementing our broken wing butterfly. So I did quite a bit of additional back testing on this and have a pretty good feel for where we are in terms of the best anchor strike for implementing the broken wing. Rather than anchoring the whole thing on the delta of 30 and then coming out to the distant out of the money long and setting up that as a defined distance, what we focused on now, and this works much better, is anchoring the butterfly. And one of those approaches does this, by the way, that we've talked about. One of the other ones is that but the others don't really, where you start by having an in-the-money long put. And it can be very close to being at the money, but it does need to be in the money. And by definition, we're just saying the first strike that's in the money by over 5 points in the SPX, for example. But as I've discussed before, we want to favor the 25-point strikes. So sometimes that has to be, even closer in than 5 points. Or you may need to go a little bit farther in the money by well over 5, maybe 10, a little bit more than 10, to hit that 25-point strike, because executions in the SPX definitely are better at the 25-point strike levels, okay, in the more liquid expiries. So keep that in mind, but we begin with that in-the-money long put. We then go to the short put that has a delta of minus 30 or as close to it as we can. Again, we're going to fudge a little bit and go to the 25-point strike if we're within 5 points either direction. Okay? And so that whole part of it is a bit discretionary to favor that 25-point strike level. And then once we get those first two strikes, we then go out, distant out of the money, to the delta adjuster strike. Prior to this, we were setting up these last two and using the adder in the money as our delta adjuster. And you know what? That just ended up not working out as well in terms of consistency and having a consistent upside adjustment level. Just didn't work. I'll just make that point in a little bit. Once we put this delta adjuster and we start proposing it, okay, we want to have delta be as close to 0 as possible, but at the same time, the other ideal is that our entry debit is less than 5% of the initial capital required. That means if the $10,000 is required, your debit is under $500. Okay, so the delta is the first consideration, and then you go to the capital, the debit being under 5%, and that combination, works out very well. And then we scale into risk. We walk in half of our capital, and then we walk in the second half after some trigger points are hit. All right, so here's one example we've been using a lot. November 2nd, 2016. Market had come down, vol had pumped up. Just a brief illustration here. So our anchor, which should be our at, or I'm going to say the in the money. Okay, now notice with the market at 2097.9, this 2100 put is just slightly in the money. Okay, we prefer it to be a little bit more in the money, but you know what? It's a 25-point strike. We're going to favor that and anchor our butterfly right there. And then we go to the strike that's closest to having a minus 30 delta, which works out to be, in this case, a 25-point strike. And then we go farther out of the money for our delta adjuster that takes us down to about as close to delta neutral as we can get. It's a 25-point strike, which is very ideal to have all three strikes being a 25-pointer. And then our cash flow is under 5% of the net requirement here. Okay, when we analyze this, this is kind of typical of what we'll see. We'll be slightly in the money right here. Okay, we want to be under the tent by just a little bit. We definitely do not want to be outside, completely outside the tent to initiate the position. We want to be inside. And that's what we were doing initially. We were ending up outside the tent just to start the position, and that just didn't work out as well in the long run. The short strike, we are at as close to the minus 30 delta as we can. And then we go out here, and this is the delta adjuster farther away. That makes for this flat line to be real close up to that expiration break even, which is real nice. If the market takes off on the upside, you know, we're not going to have a whole lot of risk, you know, on the big upside moves. And this delta premium or delta neutral approach, so often when you're doing condors and other, you know, strategies, you know, those big up days can be just killers for some people. And here, if you have that flat line there as close to expiration break even up as possible, easily here it's at 3% underneath, but you know, after making some adjustments, and if you, as theta kicks in, we start making money, that can actually be lifted to at the break even or even getting higher. Okay, and so we're not going to freak out when the market blasts off, as it can on, you know, in a bullish market. So this is the typical risk graph that we're going to see here. I just had this illustration left over from last time, noting that our previous approach where we were using the add and in the money put as our delta adjuster sometimes resulted in us being outside the tent. Here we're right on the edge of the tent. We prefer to be underneath it. But when you calculate your upside trigger for scaling in or rolling, okay, we're taking the expiration break-even point plus 1%. And if the market is sitting here, you know, and we're using the old approach that we had, well, that just isn't very much room. You know, a little more than about 0.5%. Here we want at least a full 1% to give the market room to breathe on the upside. We want at least 1% for the market to breathe from where we begin the position, and that's just back tested out. It's much easier that way to give the market some room, let the theta kick in, and get some returns going. The advantage of this, all right, is using that in the money long strike as the you know, using that as the delta adjuster resulted in using strikes that vary in distance from the current market price instead of that rock solid at least 1%. The upside trigger is therefore inconsistent over time. It's better to anchor the butterfly with a consistent slightly in the money strike. Okay, now once we put this on, what are the triggers for scaling in the other half of our capital? The upside triggers I mentioned is taking that expiration break-even point times 1.01. The downside trigger is the short strike. Real simple. If you're fully invested, okay, then we're going to use the most distant one in terms of rolling the position for leapfrogging. I'll get to that in a second. So here's a typical situation. We're starting out. We're barely under the tent over here. We take the expiration break-even times 1.01. That puts us right here. That's our trigger point for scaling in the other half. The short strike here is the trigger point for scaling in if the market moves down. And last week I showed you a clear example of doing that. When the market just takes off to the downside, hits it, then what do you do? In this case, 2 days later, the market moves up. Our trigger is hit. We're at 1% above that expiration break even right there. We hit our place. Now what do we do? Okay. Okay. Same rules. The anchor strike is the in-the-money long put. Slightly, at least 5 points. We favor the 25-point strikes. Minus 30 delta is where the short is. We go farther out of the money using the delta adjuster and adjusting the delta and trying to keep that debit under 5%. Same rules as initiating the campaign at the very beginning. So in this case, when we add that second butterfly on, we have the minus 30 delta here. We're right, just barely in the money, okay, with this long put. I should say ITM anchor strike. We want it slightly favoring in the money. And then the delta adjuster is out here. We have a very flat T plus 0 line, and we're lifting that expiration break-even line up. Here we're at just $333 to the debit on a total net capital requirement of over $57,000. So certainly we're right there. Are we going to freak out if the market blasts off to the upside? No. No, because theta is still kicking in, and we know we're not going to get destroyed on a big up move here. Now, triggers for now making, and I'm going to put this in quote, adjustments. Last week we introduced the concept of leapfrogging. We're really not going to make adjustments. We have the same triggers to the upside, expiration break even times 1.01. The downside trigger is the most distant short strike. What to do if we're triggered? We're going to remove and replace. We're going to remove that old butterfly that's with the most distant short strike. We just take it off, and we add another one using the same rules. Using the same rules, we call it leapfrogging, and this just keeps things simpler, easier to execute. You're not going to end up with this combobbled goop of positions, maybe 2 butterflies plus an added call plus a spread here. No. We're just going to remove and replace, and leapfrog the butters and let theta kick in, and away we go. And so here's the trigger points, just an example. Okay, you have we've scaled in that second one. We have the expiration break even times 1.01. Now, by the way, if this is positive, okay, and there is no expiration break even to the upside because this whole thing is now a positive. It doesn't come down below that 0 break even. It stays above it. Just take that long strike right there and go 1% above that. Okay, real simple. And then the distant short strike on that first butterfly, that's our other trigger point for leapfrogging. Okay, and here it actually is an example. It went up here. It hit that point. We're not freaking out. We're actually still making a little bit of money, but what do we do now? We get rid of that first butterfly we put on another one with a short at the minus 30 right there. So we're just rolling that butterfly over, or leapfrogging over the second one we put on. And away we go. When you add an incremental butterfly, does your delta adjuster long strike adjust the new position to 0, or does it adjust the entire position to 0? Brian, absolutely, the entire position. The entire position. And if you're making money, what will typically happen is that you'll put on that delta adjuster. The total position delta will be around 0, and the debit is it's actually now risen above, and it's actually a positive number. Your total is going to be actually a credit coming in, okay? That's what it worked out to. Okay, now, I went through backtesting using this new implementation approach where we're anchoring it in and it definitely changed some of the results. It got rid of the 2 losses we had last week. I think that could be just, given there's only 18 campaigns. Last week we had 16 winners, 2 losers. Now we have 18 winners. Is that due to randomness? Perhaps. But just going to report on it anyway. I think it's pretty cool how this worked out. And I could tell you, backtesting it through, it just seemed more intuitive to anchor on the in-the-money put. Just made it a lot easier. All right, so here's what we do. We only initiate near the close of and I'm going to call these technically qualified days. I'll review that real quick again. Use the first expiry with over 60 days till expiration. We're doing our 5% profit target on the total net capital required. That's after you scale in the second half. We have a 5% downside or loss allowance, and we get out. We're going to leapfrog up to there being 35 days to expiration. And then we will do a campaign stop at 30 days to expiration. Now, if our leapfrog trigger hits between 30 and 35 days, are we going to go ahead and do the leapfrog? No, we're just going to close out then in that case. Okay, because you're getting into that area where we're so close to 30 days campaigning stopping the campaign. What if you have 32 days left? Are you going to do a complete leapfrog? No. Give your leapfrog at least 5 days remaining until the campaign stop. That's how we did it here. Okay. With that said, let's go to this technically qualified situation. We talked about this last week. Again, this comes from a couple years of Inside Wire presentations, where we and also it's in our core curriculum now. Timing these strategies using technical indicators. And it's, many hours of presentations went into making these conclusions that we want to favor markets that are above the 50-day simple moving average this is in the SPX. And if you are above the 50-day simple moving average, the only environment to avoid using these strategies is if the stochastic, the 15-3 stochastic, has turned upward and you're under 33. Okay, that's a real good indication that you have some strong upside volatile movement to the upside. It's a great bullish environment, by the way, great for bull put spreads. But for putting on neutral positions, it turns out that in those environments, it's more likely than normal you're going to have you're going to encounter a price point where you have explosive moves up or down, typically to the upside, but in terms of premium neutral or market neutral premium selling, you'll encounter a more volatile market than what is being implied by the option prices. It's more likely that that's what the case will be. Aside from that, if you're above the 50-day simple moving average, you're good. If you're below the simple moving the 50-day simple moving average, you should simply avoid these premium or neutral premium selling strategies because it's more likely more likely than normal that you'll encounter a more volatile market than what is being implied by the option prices. Now, does it mean you can't make money? Well, no. It's just a matter of probabilities. If your adjustment approach is just foolproof, well, then be my guest. But we're just simply favoring markets where it's more likely than usual that you'll encounter a less volatile market than what is being implied by the option prices. Okay, so this is what we mean by technically qualified, above the simple of 50-day simple moving average, but avoiding that particular stochastic situation. And I program my Metastock program to show me blue bars and red bars when all this takes place. And there were a few times, folks, where we got out of a position and then had to wait. Here, back in 16, we concluded a position along in here and had to wait a couple weeks before we were technically qualified again. And then we avoided all this kind of mess of volatility. And just because we were below the 50, okay? And away we went. And then, and then it was clear sailing after that. What was the stochastic period again, Brian? I use a 15-3-3. 15-3-3 setting on mine. All right. Here are the back-tested results. Moving right along. Here we go. So in OptionVue, 18 campaigns. I put in 80,000 to cover. I'm going to, a little bit more on that later. 18 trades. I was doing 5-lot butterflies in the SPX. Sometimes the capital required was far less than at other times. After scaling in the other half, it was at the most I would go over 70. Sometimes it was down just under 50,000. And that's a problem. And I'm going to address that in a bit, and that'll be part 2 of this backtesting. Is when we begin to normalize for that. What else here? So the average winner, let's see, do we have an average winner? Yeah, it was over $2,000. You know, with roughly between 50 and 70,000 required for the after we scale in both sides, both positions. All winners, 18 winners here. Putting in 80,000. Here's the equity curve. The return was 45.8. I went from roughly the first trade was in Feb of 16 because nothing was technically qualified in Jan. And then so we go in 16 with the commencing our first campaign, finishing up just yesterday. Just taking it up. We have just a few more days left in this last. I just took it off just to see where we would be, and it was a winner. But here's the deal: annualized return of 26.7. That's on 80,000. And what you'll see here on the realized gain loss report is I use just a consistent 5 lot here. And this is where I have to go through and now begin adjusting the positions to match a consistent amount required. I want to have a consistent level of capital and adjust the position size because the width of the butterflies vary depending on volatility and the skew and all that stuff. So that's my next challenge, is I'm going to go through these signals and begin adjusting the positions sizes and just see where that takes me to try and maximize the capital required better, in a better fashion. Slippage, Brian, I used no slippage on the SPX. I had the commission set at $1 a contract. Okay. And that is where we're at. There were 2 losses last time we went through this, and they were consecutive. By adjusting the anchor, this remove those, but that could be random. But I think the all in all, I think the results are just awesome. And again, that's the next project, is to take these parameters, the trigger points, the implementation rules, and start now going into capital maximization, and come in for a landing on that. And then we'll have a complete and total trading plan after that we get the capital figured out and the contract size set up. Okay, so that's the next plan, and then we'll have then we're going to adjust our core curriculum butterflies in accordance with this, because this is looking real good. All right, folks. Excellent. All right, Brian, thanks for joining us live. Those of you watching the recording, have a great rest of the day. We'll talk to you later. See you next week. Bye-bye.